In today's video, I'm going to show you 20 fast price action patterns. These are also called short-term patterns in the relevant literature about trading. You can implement these patterns in your strategy right away, no matter which type of strategy you use. Most traders are used to the classic chart patterns such as head and shoulders, double tops or bottoms, triangles, and so on. However, there are a number of other price action patterns that can be useful for any price action strategy. Classic chart patterns are usually formed by several candles or bars, so they tend to be slower formations. Fast price action patterns are only formed by a few candles or bars most of the time. They are different than the famous candlestick patterns because they have a Western origin for the most part. Before we explore the list of fast price action patterns, let's go over a few pieces of important information about them. Fast price action patterns can be used as objective trade entries or exits with tight stop-loss orders. Such patterns are much more frequent and easier to scan than the classic chart patterns, and of course, they happen in any market and any time frame. They can make the classic chart patterns more reliable by pointing to trade entries before the breakout of patterns, which is the standard way of trading the chart patterns. You can often find fast price action patterns in significant price reversals. Fast price action patterns have an intermarket characteristic in the sense that a pattern in one market can signal a reversal in another market. These patterns are designed to allow the trader to anticipate big moves in price. You can learn about chart patterns and many other trading methods in my free playlist here in the channel, so make sure you check that out. Let's briefly go over the main characteristics of fast price action patterns. Fast patterns emerge when we look at the relationships of position and proportion of candle or bar in relation to itself or in relation to previous periods. Certain fast patterns are split, meaning that the signal of a pattern is only completed when a complementary fast pattern appears later. Like chart patterns, fast patterns are composed of a setup and a signal. The setup is a preparation, and the signal is the trigger to enter the trade. Fast patterns tend to provide more precise entries in comparison to classic chart patterns, but they are not mutually exclusive. In fact, there is benefit in combining them. Similarly to anything else in price action or technical analysis, the fast patterns should be integrated with other tools for better results. For example, such patterns are much more reliable when they occur at a significant support or resistance level. It's important that you understand that these patterns are not my invention. They have been part of the trading culture and have been well documented for decades. Without further ado, let's begin by exploring the first set of fast price action patterns, which is composed of several types of gaps. Gaps occur when there is a space between the high and the low of adjacent candlesticks. The void between candle or bar extremes signifies a price range where no trading activity has occurred. Gaps have been used extensively in technical analysis for a very long time. There are types of gaps with true meaning, and there are gaps that are meaningless. The difference can be spotted by analyzing the context where these gaps occur. Gaps are more common in markets that have lower levels of liquidity. Let's begin with the first type of gap, called Breakaway Gap. The Breakaway Gap is a gap that occurs at the very beginning of a trend. The most profitable gaps occur at the beginning of a trend. The size of the gap is an indication of how powerful the subsequent move will be. The proper way of trading a breakaway gap is to wait for what's called fading after the gap occurs, meaning a small consolidation. If price seems to fail in attempting to close the gap, we have a signal to enter in the direction of the gap with a stop where the gap would be filled. If a gap is filled, it usually means that the market will go significantly in the direction opposite to the gap. Dave Landry has outlined an objective way of trading breakaway gaps using what are called pivots. A pivot low occurs when a candle or bar has a candle or bar with higher low to the left and to the right. A pivot high occurs when a candle or bar has a candle or bar with lower high to the left and to the right. Notice that what ICT calls swing highs and swing lows is exactly the same idea of the Landry's pivots. In an upward breakaway gap, the trader waits for price to create a pivot low. The entry occurs if price breaks above the candle on the right, and the stop is placed immediately below the pivot. It's important that the pivot occurs in such a way that the upward gap is not filled. In a downward breakaway gap, the trader waits for price to create a pivot high. The trader waits for price to create a pivot high. The entry occurs if price breaks below the candle on the right and the stop is placed immediately above the pivot. It's important that the pivot occurs in such a way that the downward gap is not filled. Runaway gap. Runaway gaps are a continuation signal, and they usually occur in the middle of a strong price movement. This pattern serves as a reference of how far the movement will go, which is very useful to determine a logical target for a pre-existing trade. Upward and downward runaway gaps work slightly differently because volatility in bearish movements tends to be higher than in bullish movements. Statistical research conducted by Thomas Bukowski suggests that runaway gaps indeed occur at the middle of strong trending movements. Trading the runaway gap can be tricky since price is not near a reversal point in a major sense, but the trader can, for example, use Dave Landry's idea of the pivot to enter a trade, similarly to what happens in the breakaway gap. Exhaustion gaps. Exhaustion gaps occur at the end of a trend. To differentiate between the exhaustion and the runaway gaps, the trader must observe the behavior of price after the gap. If price fills what appears to be a runaway gap, the trader can assume that it's actually an exhaustion gap. Obviously, price action can trick you in dozens of ways in the process of differentiating between these two types of gaps. In the case of exhaustion gaps, the trader can also look for other types of indication that a trend might be near its end, such as an Elliott wave count, the appearance of exhaustive volume patterns, and/or the appearance of common reversal divergence patterns, for example. I have created a video in the channel identifying 16 ways of anticipating a price reversal, so it's a good idea to watch that if you want to gain superior knowledge on how to spot price reversals, which is what everybody is after at the end of the day. Fair value gaps. Fair value gaps, which are popular among ICT followers, are similar to common gaps. The fair value gap is a 3-candle pattern where there is a space between the upper shadow of the first candle and the lower shadow of the third candle in the case of a bullish fair value gap, and a space between the lower shadow of the first candle and the upper shadow of the third candle in the case of a bearish fair value gap. A fair value gap is nothing more than putting a candle within two gapping candles. It's what would happen if a gapping market was traded continuously. Price can interact with the fair value gap in the same way that price will often interact with gaps that are more obvious. The name fair value suggests that price is supposed to return to the gap between the first and third candles, but price is not supposed to do that at all. Price returning to that space is just one possibility, in the same way that it can keep going without ever returning to the fair value gap. Notice that there is nothing new about a fair value gap, it's just another way of seeing normal gaps. The spike. The spike, also known as high volatility candle or wide range bar, is similar to gaps in a way because they show a leap in price activity, but this leap occurs within the period of formation of a candle or bar instead of between bars. The fair value gap in the ICT method is usually formed by spike bars. Notice that spikes at the beginning of a trend have the same meaning of a breakaway gap, spikes at the middle of a trend have the same meaning of runaway gaps, and spikes at the end of a trend have the same meaning of exhaustion gaps. Spikes can also serve as future points of support and resistance. The opening price of the spike is sometimes interpreted as a moment where volatility shifted dramatically in the market, so it's natural that traders will react to these levels in the future. Sometimes, ICT followers will think that price is reacting to the lower end of a fair value gap, but recall that a lot more people look at spikes as shifts in volatility, and they will react to the opening price instead. That means ICT followers think that price is reacting to the fair value gap, while in reality, price is reacting to the shift in volatility, which is a much more common and famous pattern in the technical analysis world. Dead cat bounce. The dead cat bounce has been a very famous pattern in Wall Street since the 1980s. The pattern is very simple. It's just a failed rally after a significant decline. This decline must be obvious to the point where it stands out in the chart. It's common to find breakaway gaps or spikes in the sharp decline part of the dead cat bounce. Trading the dead cat bounce requires that the trader observes the decrease of volume after the sharp decline, and then price coming back to one of the edges of the gap that is formed or a previous resistance level if the sharp decline happens in the form of a spike. Once again, ICT followers will believe that price is reacting to a fair value gap, an ordered block, or a breaker block, but in reality, it's just reacting to established support and resistance levels. Most powerful traders that react to simple support and resistance levels, and therefore can nudge the market in these levels, are not even aware of the existence of such a thing called ICT method. They trade in part based on the traditional tools of technical analysis, many of which have been developed in the 20th century. Island reversal. The island reversal is the combination of two gapping patterns, but since spikes can hide gaps in lower time frames, or at least trading activity that would be similar to gaps, we can also find variations of island reversals that are formed by opposing spikes. The classic form is an exhaustion gap formed after a long trend, and then price forms a breakaway gap in the opposite direction. One-bar reversal. The one-bar reversal has been called many different names throughout the history of technical analysis, such as reversal bar, climax, and key reversal bar. In a bearish one-bar reversal, price has to trade higher than the previous bar and close below the close of the previous. In a bullish one-bar reversal, the logic is the opposite. A lot of the times, that pattern will imply an outside bar or candle, which is a fairly common pattern as well. Notice that this pattern is very similar to what I call the fractal bar in my strategies. Even though all one-bar reversals are fractal bars, not all fractal bars are one-bar reversals. Beyond that, the key component of a fractal bar is to understand how it shows a momentum divergence in different time frames without the necessity of switching time frames. Pipe formation. The pipe formation, as it is called by Thomas Bukowski, is a two-candle or two-bar reversal pattern. A pipe bottom is formed by a high volatility candle that closes on its lower range and immediately followed by a high volatility candle that closes on its upper range. It's as if price accelerates to the downside, encounters demand, and reacts to the upside right after. The logic is exactly the opposite for a pipe top. Horn formation. The horn formation, also outlined in Bukowski's work, is similar to a pipe formation, but there is one candle in the middle. The name of the pattern is a reference to the look of the pattern in the chart. Both pipe and horn formations are the strongest when they stand out in the charts, and also when they are reacting to strong support and resistance levels. Inside bar. The inside bar is a famous price action formation that occurs when the current candle's range is contained within the previous candle's range. It represents a momentary stop, so by itself it means almost nothing. However, the context in which an inside bar occurs can transform it into a powerful pattern. If an inside bar stops at a support or a resistance, for example, there is indication that the market might respect that level and reverse. The classic way of trading the inside bar by itself is to use it as a bidirectional setup since it means a momentary stop in price. The trader can place a buy stop order above the high of the inside candle with a stop loss below the low of the inside candle, and at the same time a sell stop order below the low and a stop loss above the high. Notice how this can work very well, but you can also have the possibility of being stopped out in both trades if an outside bar happens right after the inside bar. Hook reversal. The hook reversal occurs when there is a series of candles or bars of the same bias and then an inside bar of the opposite bias appears, clearly standing out from the previous movement, therefore signaling a reversal. The important part about this pattern is that the change in bias stands out in comparison to the smoothness of the movement of the preceding price action. Naked bar upward reversal. The naked bar upward reversal is a variation of the hook in some sense. Price must be producing lower highs and lower lows, and then a bearish bar closing on the extreme of its lower range appears, meaning with the most bearish close possible. Following that, an inside candle with an opening above the previous candle's close appears, signaling a bullish reversal. Hikkake. The Hikkake is a way of training the failure of a standard inside bar signal. For example, when price breaks above the inside bar, the standard signal is to go long. In that case, a Hikkake occurs when price fails to continue upward, and then price breaks the low of the inside bar within 3 bars of the inside candle, therefore generating the opposite signal. The opposite logic is also true, of course. The term Hikkake in Japanese means trap. Outside bar. An outside bar or outside candle is considered to be a special kind of wide range bar whose range encapsulates the range of the previous period. That is seen as an indication of emerging power. This type of signal is generally used as a setup when it occurs near an important price level like previous high or low, or at a support and resistance level of some kind. Larry Williams' OOPS pattern. The famous Larry Williams OOPS pattern is a way to take advantage of an opening gap using stop orders. When the trader sees price gapping down, he can place a buy stop order at the low of the previous candle with a stop loss at the open of the current candle. This is a way to get into a reversal very early. Obviously, this has to be done rather quickly and at the open of the second candle. Shark. The shark is a 3-candle or 3-bar pattern that is formed by 2 successive inside bars. The second inside candle is called apex in this case. The shark pattern is basically a compressed version of a pennant. The candle that precedes the first inside candle is the base. The trigger for this pattern happens at the breakout of the base with a stop loss below the base. NR4. Just like there are high volatility patterns such as the spike, there are also low volatility patterns. 2 of the most famous are the NR4 and the NR7. The logic is very simple. The NR4 is simply the candle with the narrowest range among the last 4 candles, including the current period. This is a bidirectional breakout pattern. A buy stop order can be placed above the high of the NR4 with a stop below its low. At the same time, a sell stop order can be placed below the low with a stop above the high. Ideally, only one of the orders will be triggered, allowing the trader to get into a good trade early on. NR7. A famous variation of the NR4 is the NR7, which follows the same logic, but instead of being the narrowest range candle among 4 candles, it represents the narrowest range candle among the last 7 candles. The entry and stop orders follow the same rationale. The narrower the candle that signals the pattern, the tighter the stop, but also the higher the chance of being stopped out. It's possible, of course, to suffer a double stop loss in the narrow range patterns if an outside candle occurs right after the signal, for example. Opening range breakout. The opening range breakout is a very popular intraday trading pattern. It consists of trading the breakout of the price range forming at the beginning of the trading day, usually the first 15 minutes, although there are several variations, methods, and different kinds of confirmations that have been developed over the years around this pattern. This is a pattern formed by many candles, but it's considered to be a fast price action pattern since it happens at the very beginning of the trading day. That's it for this video. If you like the material I produce, please consider purchasing one of my courses and/or ebooks. You can find out more about them in the video description or in my website fractalflowpro.com. If you have any questions about this video or the courses and ebooks, you can send me an email at support@fractalflowpro.com. You can also support the channel by clicking the like button, subscribing to the channel, activating the notifications, leaving your feedback in the comment section, and sharing the video with your trading community. Thank you very much for watching, and I hope to see you in the next videos. Take care.